Hello everyone, welcome to International Corporate Finance, Semester 2, Week 11. This is video lecture number 7, and it's a continuation of our previous video on project appraisal. And we're doing this question called Nevada Limited. Now, we discussed Nevada Limited in our last lecture, and we discussed some of the points of theory in relation to project appraisal. So let's just briefly review then what we said about project appraisal, or about Nevada Limited rather. Okay, so the first thing we say is it's a new long-term project that's proposed, and the first two bits of information were in relation to the purchase of machinery and the investment in working capital. So both of these are going to be cash flows, as we said, in year 0. Okay, now remember that in the case of the machinery, we said that at the end of the project this machinery was going to be sold, so there'll be a cash flow in the final year because to deal with the proceeds of that disposal. And also we also discussed in our last video about how we treat working capital, that in the beginning, in year 0, it's cash out, and in the final year of the project it's going to be cash in. So we're going to include this figure twice in our calculations, okay, in year 0 and in year 5, the 5th year, 2025. Okay, we were told here then that these were the sales figures that are expected for each of the years. Now remember, these are estimates, and it's, we're looking at quite a distance ahead, so they're the best we can establish at this time what the sales revenues are. So we said that we were going to convert these figures to take account of this 4 months credit. So that's one of the things we're going to have to do. Okay. The other thing we said was this gross margin. So we have a way of calculating our purchases of stock, and we discussed that in our last video. Okay, so we said that essentially our purchases of stock would be 20% of sales because the gross margin was 80%. And then the next cash flow going out, we said, would be labor cost and overhead cost, which are each 10% of sales. All right. The next bit of information is that there's research costs. Okay, now these research costs are incurred prior to the project. So we discussed that, and we talked about sunk costs. And we said sunk costs, which are costs in the past that before we commenced the project, and we're not going to include them because they're not incremental, that these costs, while they haven't been paid yet and won't be paid till the first year of our project, have to be paid whether we go ahead with the project or not, so are not incremental, and we regard them as sunk costs, so we won't include them. We also talked about our head office costs, and we talked about the allocation of head office costs, and we said that generally head office costs that are allocated are not going to be included in the calculation. However, if there's additional head office costs, administration costs, we would include those. So we're certainly going to include that 50,000, but not the 140. The equipment used on the project will be sold at the end of the project for 100,000. So I referred to this earlier. This will be a cash in the final year of the project. And there's depreciation. Now, we discussed depreciation in our last video, and we said that it's not a cash flow. It's an accounting idea, and we're not going to include it in our calculations. Okay. The next bit of information we're given is this idea of the cost of capital, and here we're referring, this is information so that we can take account of the time value of money. And so what we're saying is that the cost of capital is 10%, so I think we can use this as an assumption that money will lose its value by 10% each year. And we saw the way to calculate that, okay, in our last video, okay. And we introduced the idea of discounting in our last video and tried to work it out. Okay, so we said that we were using 10% as we did in the example previously, And this is an alternative. There is an alternative than doing the calculations mathematically, and that is to use what we call a present value table. And this is an extract from a present value table that you will be given as part of your exam paper. So it will save you doing the calculations. So remember that this one here, this 0.9091, this is the discount factor, 10% for 1 year. And how we calculate that is simply, like we said, divide, it's the present value of €1. So we just divide €1 by 1.1, and that's how we get to 0.9091. So these figures will be given to you in the exam, so you don't actually in general have to work them out. Again, another example is in year 3. How do we calculate that figure? Well, simply we discounted 3 times 1.1 to the power of 3, and when you do that 1.1 to the power of 3 and divide into 1, you get 0.7513. So what we're saying is that 0.7513 is the present value of €1 received in 3 years' time. Okay, and the final one here is is year 5. Remember, it's a 5-year project. Okay, we've included 6 years, so it's a 5-year project. So how we got that 0.6209? We divided by 1.1 to the power of 5, and that will give us 0.6209, meaning that the present value of €1 received in 5 years' time is 0.6209. Okay, right, okay. Now we have a situation where some of our cash flows are going to come in 3 months, or 4 months rather, after the end of year 4, and this is because we're giving credit to our customers. So we're going to be receiving money 4 months after the end of our project. So we've got to come up with a discount factor, if you like, for 5.333 years. Okay, and we've got to figure out what that is. Okay, what is that going to be? Well, what would the formula for it be? I'll just put the formula for it out here. Okay, well, what it will be, it'll be 1 over 1.1 to the power of 5.33, so on, years. Okay, now the way to calculate that in an exam situation is, well, I suppose you could calculate it by it's somewhere between, we know it's somewhere between the discount factor for year 5 and the discount factor for year 6. So I suppose what we could do is we could say, okay, it's the difference between those two. So we'll just put it over here. So year 5, okay, the discount factor is 0.6209, and the discount factor for year 6 is 0.5645. Sorry, 5645. Get rid of that. Okay. 0.5645. Okay, and the difference between the two is, if you subtract those, it's 0.0988. Okay, so that's the difference. So that's the discount for that one particular year, I suppose, the difference. And I suppose 4 months is a third. Okay, so a third of that, sorry, okay, sorry, let's go back there. That's not point. Okay, so we'll, what that is, in fact, is point, if you work it out, it's 0.0564. And if you get a third of that, it's 0.0188. Okay, so 1 year, the difference between year 5 and year 6 is 0.0564, and we want a third of that. So really what we have to do is subtract, if you like, that figure there from year 5, okay, from year 5, and just subtract it, okay. And the answer we're going to get for 5.33 years will be, well, what will it be? It'll be 0.6015. Well, I think actually it's, yeah, 6015 or thereabouts. Okay. Now I wonder, is that right? No, it's 0.6021. Okay, so we put that in 6021. So it's 0.6021. Okay, so that will be our figures. That's one way of doing it. Okay, one way of doing it. So we could put in here 0.6021. So that's one way to calculate it. Okay. All right. Now another simpler way in your exam, because you'll be doing it online and it'll be open book. And the other way is just simply to go on Google and say, what is the power? What is the power of 5.3? What's the power of 1.1 to the power of 5.33? And that will give you an answer. And the answer that gives you is 0.6015. So Google will give you that answer. Now the Google answer is in fact the right answer, because what we did here, our little calculation here, was an approximation. So I think we're going to use this answer. I think it's easier to do that. Okay, so if you either use Google or you can use a calculator. Okay, so if your calculator is able to do this calculation, okay, so you can use a calculator. Okay, so there's your choices. Okay, so you can do it this way with this technique here, which is an approximation, which will do. You use a calculator, or you can use Google and just do a search. Okay, so we'll put in 0.6025 here. Sorry, 6015. So that's it. Okay, so that's how we're going to discount. So we're going to do it in a more simplistic way. We're going to use the present value tables, and where we have this situation with credit given, we sometimes have to do this part of a year that we have to discount by. So that's that. Okay, so let's go on and do the question. Okay, let's do the question and see how it works out. So I kind of just did a layout of it here. So we're going to do Nevada Limited. So you need to kind of lay it out. There's no fixed way to do this. It's not like a profit and loss account or a balance sheet. You do it any way you like, really. But we're doing it, we put the name of the business, and I suppose we want to put in the title of what we're doing, okay, a description of what we're doing. So we're doing a project appraisal for Nevada Limited, and it's a project that's going to start on the 1st of July 2020, normally to be a project code or project description. Okay, well, the first thing I think we need to do is get our dates in order to make sure we're sure about the time scale that we have. So year 0 here is a notation that we use for the start of our project. Okay, so the start of our project, we were told, is the first, you might as well put these in, the 1st of the 7th this year, 2020. Okay, so that's what we call year 0. So year 0 is not a year at all, it's just the first day of our project. Year 1 then is the first year of our project, but we always assume that the cash flows, as a simplification, that the cash flows occur on the last day of the year. Okay, so year 1, we're going to say that the cash flows, any cash flows that occur during the first year, all occurred on the 30th of the 6th, 2021. Which is the last day of the first year, which is exactly 12 months after the beginning of our project. Okay, and this facilitates the discounting. Okay, as we'll see. Year 2 then is the 30th of the 6th, last day of year 2, 30th of the 6th, year 22. This is the 30th of the 6th, 23, 30th of the 6th, 24. And the last year of our project ends on the 30th of the 6th, 2025. So the project is over at this stage. And we said that because we're giving credit to our customers, we've got an extra 4 months, which is 1/3 of a year, 0.333 of a year. And what's the date of that? Well, it's the 30th, it's 3 months into the next year, the 30th of the 9th, September 2025. So there's our years. Okay, our years are important dates for during the project, and everything is going to be expressed in money. So we're going to do it in thousands of euros. So let's put that in. Okay, so you can put these cash flows in. We're going to arrange the cash flows depending on year, and you can do it in any order, but I think when we have sales on credit and we've got to make an adjustment to our sales, as we have to do with Nevada, I think it's a good idea to do the sales first. So let's do the sales first. So let's put in, what do? We do it in blue. Okay, so the first one is okay, so we want to figure out the sales. Well, we're not really interested in the sales, but what we're interested in is the cash from sales. And in our previous video, I think we said how to do that. But I think the first thing to do is put in the various sales figures for each year. Now, year 0 is not a year at all. So the first year we're going to be dealing with is 180 is the first year's sales, 360 the second year, 720, 720, and 360. And the project is over at that stage. Okay. So in our previous video, we said that if we want to turn or translate these sales accounting measure of revenues, these sales figures, the invoice, what we plan to invoice during the year, and we want to translate that into cash flows, what we have to do is we have to subtract. So we say less closing debtors. And we discussed this in video number 6, I think it was. So we're going to subtract the closing debtors. Okay, so let's do that. The closing debtors, well, the closing debtors is at 4 months. 4 months, these sales occur evenly over the year, we're assuming. So 4 months, 4/12 of that is a third. So 60 of those, that 180, will not be received in that first year. In the same way, 1/3 of 360, 120 will not be received. 240, which is a third of 720, will not be received until the previous year, and so on. 120. So 120 in the final year will not be received. Of course, it's going to be received later, but we'll do that first. So we always subtract the closing debtors. And what do we get? Well, we get 120. And then this is 240. So what's this? This is 084, 480. And this is 480. And this is 240. Okay, so we're going to subtract. So this 120 in the first year, that's what we will receive from the sales of the first year. 240 is what we will receive in year 2 from the sales of year 2. But of course there's additional cash coming in. So we're going to add the opening debtors. Sorry, add the opening debtors. Don't know why that won't. Okay, opening debtors. Opening debtors. Okay, don't know why that won't. Okay, so what is the opening debtors? Okay, so the opening debtors in year 1, well, are 0. Okay, so we're not going to, there's nothing there because there was no sales of the previous year. Okay, so there's no opening debtors in year 1. In year 2, there is opening debtors, and we know that it's 60. Okay. In year 3, we know that there is opening debtors, and it's 120, 240, 240, and 120. Now, where did these figures come from? Well, this 60 here came from up here. So the closing debtors of year 1, okay, is automatically the opening debtors of year 2, and so on. So all those figures just come down like that. Closing debtors of one period become the opening debtors of the next. Okay, so let's add that then. Okay, let's. And what that should give us is our cash from debtors. Okay, so what are we left with in relation to cash from debtors? So it's 120 in the first year. It's 300 when we add. Okay, we're going to add this 600. 720 in year 4. 480 in year 5, and 120 in year 5.33, or that last 4-month period. So okay, so what we've done here is we've translated the sales figure, what we plan to sell in each of the years of our project, into what cash we expect to receive from our customers in those years. Okay, so the next thing we want to do is any other cash flows, any other relevant cash flows. I'll just change the color here. Okay, the next thing we said that there was machinery, so we put that in. Okay, so there's machinery. So we're going to purchase machinery in year 0 at the very beginning of our project, and we're going to purchase that machinery for 400. But we were also told later on in the question that we were actually, when we were finished with the project and finished with the machinery, we could sell it for 100. So you can put it in there on the same line if you wish, or a separate line. Put in disposal of machinery. But I think that's clear enough. The next one is to do with the working capital. Okay, the working capital. And we're investing in working capital the same way as we invest in machinery. In fact, working capital, stock and debtors really is a permanent asset as well, insofar as it's going to be there for a long time. So we're investing in it, until the end of the project, when we divest in it. So the working capital, in this case, it's stock and cash float. So the project needs a cash float. So we treat cash floats in the same way as we treat any type of working capital. So whether it's debtors or stock or cash floats, normally if we're not given information about the debtors here, we would deal with it in terms of working capital here. So an increase in working capital is a cash out. So it's 120. And of course at the end of the project we're finished with it, and we're going to get this 120 back. But bear in mind, of course, that's in 5 years' time. The 120 won't be worth 120, so we're going to discount this, of course, later on. The next bit of information we have is to do with the purchases of stock. Okay, and we talked about this already, and we said that because there's a gross margin of 80%, our purchases will be 10% of our sales. No, will be 20% of our sales. Okay. So we just have to work out what 20% of our sales are. So our sales are 180 up there above. So 20% of 180 is 36. Now, so this is a cash flow going out. Okay, remember this, the cash from the debtors is coming in, so there's no brackets. But cash flow going out, we put it in brackets to indicate that it's a negative or a cash flow going out. 72 is the figure for purchases in year 2, which again is just 20% of 360 sales. The next one, 144, 20% of 720. Again, 144. And in the final year of a project, it's 72. All cash flows going out, 20%. Labour, we're told, given some information about labour, and we're told that labour is estimated to work out at 10% of our sales. So that's easy. We just get 10% of our sales. So 18, 36, 72, 72 and 36. Okay, overheads the same. So these of course are other costs, could be anything, any other costs other than materials and labour and admin, and it's 10%. And again, same figures. All cash flows going out. 72 and 36. Now remember, there's no total column, okay? Unlike the cash budget, people sometimes get confused when we're doing this. It looks a bit like a cash budget with cash flows in and cash flows out. And in a cash budget, for short-term business planning, it's very important to put in a total column. But here it wouldn't make much sense, because remember, we're going to be discounting each of these columns at different rates. So to add it up and to make a total column really doesn't make any sense. Wouldn't help us. Okay, admin costs then. Okay, the admin costs. Administration. And we were told we're only going to include the incremental admin costs, not the allocated administration of the head office. So it's 50 going across. Now the main point, one of the things to watch here is that what we're not putting in, okay? So in an exam situation, you'll get marks for not putting in certain things. So what we don't put in is any reference to our research costs, which are pre our decision, okay? And are regarded as sunk costs and not incremental. So we don't put any research costs that we incur prior to the project starting. And we don't put in any depreciation, because depreciation is an accounting concept and doesn't involve cash flows. So we're only interested in cash flows. Okay, I think that's it. I think we've everything now. So let's add it all up. So I'm going to add up each column to get our net cash flows. We're going to add our cash flows in and our cash flows out, one being positive, the other being negative, and we get our net cash flows. So let's put in a different color, so if it's not too, yeah. So net cash flows. Okay, so in our year 0, all we have are these figures going out, the machinery and the working capital. So that's 520, and it's a negative. Okay. So that's normally the case with these projects, that up front in the beginning of the project we've cash flows going out, and maybe in the next year, in this second year, we also have a small amount of cash going out. It's 2,000. Okay, in the second year then we start having cash flows coming in, and it's 106. That's a positive figure, no brackets. 262 in the next year. In the next year it's 382,000 and 506,000, and in the final 4 months all we have is that 120,000 coming in from our customers. Right, what we do now is we discount, okay? And as we said, we can do it with using calculations, arithmetic, or we can use our tables. I think it's easier to use the tables. So what we're going to get here is our present value factor, okay? And we get that from our table, okay? And it's at 10%. So we're discounting all the future cash flows by 10%. And so that's what we're going to do. Now, of course, we're not going to, there's no present value factor here. We're not going to discount year 0. So if we're going to multiply by something, we'll multiply it by 1, and we just get 520. So the present value of 520 at the beginning of our project is 520. So we're going to call that the present value of our cash flows. Okay. In the first year then, our discount factor straight from the table, the present value of €1 received in a year's time is 0.9091. So what's the present value of €2? okay, or 2,000 euros, for that matter. So it's 1.8, these are all in thousands, so 8182. Okay. The next one from the table is 0.8264. Okay, 8264, and that gives us 87.5984. Then in the next year, it's 0.75. Present value of €1 received in 3 years' time is 75 cents. Okay, little more. And so what's the present value of 262,000? Well, it's 196,000, and I just put in the decimal, 0.8406. Okay, the next year is the discount factor is straight from the table, 0.6830. Okay, and that gives us 260,000. No, 906. Now, you don't really have to go to 4 decimal places like I'm going here. Like 2 is quite adequate. And okay, the last year then is 0.6209. Okay, and we get 314,000.1754. And we worked out then the discount factor. We said either we go to Google or we go to our calculator, or we work it out mathematically and get a approximation, and the discount factor doesn't really matter too much, 6015. You don't have to be too exact. It is more than 5 years away. Can't be too exact about the future. So that works out at 72.18. Okay, so that seems to be that. Okay, they're all our cash flows. Now what we're interested in here, this is what's called the net present value method, or the NPV method. Okay, so we're going to work out the net present value of this, and I think the best way to do it, I don't think we'll bother. I think we'll get to the nearest 1,000, I think. So let's just put in what the nearest 1,000 is. So we're going to add minus 520 minus, let's say 2. Okay, let's say 2. What's that? 87. Okay, 87. 197 is the nearest 1,000. 261, 314, and 72 to the nearest 1,000. We don't have to be that exact. And the net present value, therefore, when we add up all of those, we're going to add all of those, and what we end up is 410, and it's positive. So our net present value is a positive figure. And I think we remember when we did this before that the decision rule for the net present value method is that if the net present value of our project is greater than or equal to 0, we say we accept the project. Okay, we're going to accept. And if the net present value is less than 0, we're going to reject the project. Okay, and we would reject it because the present value of the cash flows going out will be greater than the present values of the cash going in. Whereas if it's the net present value is greater than 0, the present values of the cash flow coming in is greater than the present value of the cash flow going out. So that's it. That's our example, Nevada Limited. And okay, so I think that's that. So hope to see you in the next video. So take care, all the best.